Hey everyone, it's Kaya. Thank you for clicking on this video. So in this video we are going to be covering some of the most popular exchange traded funds, ETFs, in the world. And we are going to be going into detail into what exactly these ETFs are, what is an ETF, what are the holdings of these ETFs, and essentially just provide a better picture for the beginner investors out there who are interested or curious about what ETFs are and what they do. So let's jump right in. Let's first start off with what is an ETF. An ETF is an exchange traded fund, and essentially it's the exact same as a share which is listed on an exchange. So when you go ahead and you want to buy Google shares, you have to buy those shares on an exchange. Okay, but what a ETF is it's essentially a combination, a cluster of multiple shares combined into one single share. So for example, instead of you having to go ahead and buy 100 shares individually, so say I want to buy Google, I want to buy Amazon, I want to buy Apple, it's quite time consuming. When it comes to an ETF, all you need to go ahead and do is say I want to buy this one ETF, and it's the exact same way as buying a share, but it's just structured in a way that there are multiple shares in a single ETF. So it saves you a bunch of time, and it's packaged very nicely into one share, so it's quite easy to track the performance of that investment. So that being said, let's jump into my computer over here and I can show you guys some of the most popular ETFs in the world. Okay everyone, so we are going to be looking at 7 of the most popular ETFs. Now how I have arranged it is that we are going to be looking at the largest of the ETFs first, and then in descending order we are going to be looking at the smaller ones as we go along. And when I'm saying the larger ETF first, the variable we are using to assess that is the assets under management, i.e. how much money is currently invested into this exchange traded fund. So first one, and a very well publicized ETF indeed, is the Vanguard Sp 500 index. Now fun fact, this is also in Warren Buffett's will. So this index, this ETF, is there to track the S&P 500 index. That is the objective. Now the S&P 500 index is quite simply the 500 largest companies in the United States of America. Now, 3 things I'd just like to take note of over here on the right hand side of my screen is the inception date. We can see here that this was founded 10 years ago in 2010. Expense ratio 0.03%. This is fantastic, guys. This is a very, very low expense ratio, and to my knowledge it's as low as it gets when you have an expense ratio of 0.03%, and you want the expense ratio to be as low as possible because that is the fee which the fund managers are charging you for managing your money. And yeah, it's quite simple. The lower that is, the more return you have for yourself from the investment. And then underneath that, we have the assets under management, $156 billion. So that is a lot of money in terms of assets under management for any type of ETF. So definitely one of the larger ETFs in the world. Okay. So this website we're using, etf.com, also provides a nice little snapshot. Going forward, I won't be too repetitive over here, but just so you guys can get an idea what this is telling us about the ETF. Over here we can see that the first variable value, we can see it's overweight in this variable. So that's telling me that this ETF is mainly invested in value shares. Now value shares are companies which have lower PE ratios. Okay. Then we see here that in the low size variable, it is mainly underweight. So it doesn't mainly invest in low size company. This ETF prefers to invest in much larger companies. In the momentum, we see here that this is overweight, i.e. this ETF prefers to invest in companies which have a track record of growing their earnings. We see here in the quality variable that this is also overweight, i.e. this ETF likes to invest in companies which do not have a lot of debt on their books, on their balance sheet, and are consequently lowly geared. If we look here in the yield variable, we see that this is also slightly overweight. This tells me that this ETF likes to invest ever so slightly into companies which do prefer to pay a dividend, to pay something out to the shareholders. And lastly, the last variable is low volatility, and we can see that this is underweight. So in fact, this is a slightly volatile ETF. Okay, so it just provides a nice snapshot of exactly how the construction of the companies in this ETF. So if you scroll down here, guys, just shows you the performance. You can go ahead and adjust the graph to what you want to see. I prefer not looking at a chart. Okay, the history doesn't always guarantee the future, but you guys can just see here that since the beginning of the year, obviously that pandemic caused a lot of fear in the markets, but this ETF has subsequently recovered well. Over here, once again, we also just have the returns. The things you want to look at over here is the ETF and the benchmark, which is just trying to track the S&P 500. And we can see here that it does track the benchmark very well indeed. So it is 100% invested in the United States. The main sectors are technology, healthcare, and consumer cyclicals, as you guys can see. And the holdings are the largest companies in the United States of America, and all of these should ring a bell, from Microsoft to Apple to Amazon, etc. So this is a bread and butter portfolio. It is something that everyone should be familiar with, and now you guys know the VOO ETF. The next one is the Invesco Qqq Trust. This is like the sister ETF of the one we just covered. Now, the Invesco Qqq Trust is slightly more weighted into the technology industry. Now, the objective of this trust is to track the ETF is to track the NASDAQ 100, which are the 100 largest companies in the NASDAQ index. Now, as I said, this is slightly more technology weighted, which you guys will see later. So if we look here, founded in 1999, so slightly older, not slightly, much older than the VOO ETF. Expense ratio 0.2%. Okay, so definitely more expensive than the VOO ETF. So you'd want to expect a better return from this than the VOO ETF. And then assets under management, we also see $126 billion, definitely one of the larger portfolios. Now the quick snapshot over here, guys, we can see here that this portfolio is mainly invested in not value focused stocks, so more your growth stocks. We see here that this portfolio is invested in your larger companies. We see here that this portfolio is focused on investing in companies with a past track record of earnings growth, quality, sound balance sheets, and however, it doesn't favor investing in companies which pay out dividends, and this is a fairly low volatile portfolio. Okay, so if we look here, we can see it recovered. It's actually fully recovered from the effects of the pandemic in the market, and it's actually reaching new highs. Very interesting. We can see here once again that the ETF created does track very closely to the benchmark, so it's a very well managed portfolio. The majority of the investments are in the United States of America. The main sectors, remember guys, I said that this is very focused on technology, and we can see here that this industry focus is 63%, the weighting, 63% of the portfolio. So definitely very technology weighted. Then if we go over here to the holdings, we can see here that once again you have your biggest companies in America, Apple, Microsoft, Amazon, but compared to the VOO ETF, we can see here that the weightings are much more in these companies. Okay, so let's move on to another well-known ETF. And for all of my real estate investors out there who don't want to go ahead and manage a property, find a tenant, rent out the property to the tenant, this ETF solves that problem, and that is the Vanguard Real Estate ETF. Now, the Vanguard Real Estate ETF is a ETF which essentially tracks the real estate index of the United States of America, quite simply. And to be very specific, if you look here, it tracks the MSCI US REIT index. So, but as of February, the 1st of February 2018, we see that this was changed to the MSCI US Investable Market Real Estate 25/50 Transition Index. Long story short, guys, both of these indexes, their whole objective has always been to track the US real estate index. Okay, so we can see here that this fund was initially born in 2004. The expense ratio is 0.12%, so not too expensive, which is good for the investor, and the assets under management is $30 billion. Okay, so we definitely see a much bigger drop compared to the VOO and QQQ ETF in terms of assets under management. So that being said, this ETF, which mainly focuses in real estate investments, we see here that it mainly focuses in investing in real estate companies which have a slightly higher PE ratio. We see here that it also invests in companies, real estate companies, which are not extremely large. It's mainly focused on your smaller companies, which real estate companies normally are. Your biggest companies in the world right now, they are not your real estate managers. They just aren't. It's Apple, Microsoft, Amazon, tech industry things. Your real estate companies, they're just not the largest companies in the world right now. Then momentum, we can see here that this is underweight. So this ETF, the stocks that it's invested in, they do not have a track record that shows extreme growth in terms of earnings. However, we also do see that the quality of the balance sheet is also not the best, and these are highly levered companies, i.e. they do have a lot of debt. This is quite typical, however, in the real estate industry. Lots of real estate companies are able to take on a lot of debt, so it just comes with the industry, the real estate industry. Cash flow, very interesting. This ETF definitely has one of the highest dividends I've seen, and yeah, it's just it pays out a large portion of its earnings to the shareholder. And then volatility, we can see that this is quite a volatile stock ETF, right? Because this is underweight. Okay, so if you go ahead and look at the chart here, we can see that it still has not yet recovered from the pandemic. However, it is trending upwards. If we look here, we can see here that the ETF versus what it is trying to track, it is fairly close, right? Over the long term, when we look at 10 years, it is very close to tracking the benchmark. And if we look here, it is fully invested in the United States. We can see it's mainly focused in your REITs, your real estate investment trusts. And if we look here at their top 10 holdings, it is the following companies. Now, just to give you an idea, most of these holdings that this ETF is invested in, these are real estate companies which are focused on owning pieces of real estate that rent out, i.e. their tenants are in the technology, the data industry. So most of their tenants are people who need a piece of land in order to put up their data infrastructure. Having tenants who are in the data and cloud space is a very good spot to be in for these real estate companies, because the people who are throwing up these data centers, these data servers, they are normally your largest companies in America. We're talking Google, we're talking Amazon. So to have that type of a customer base, these real estate companies are guaranteed some type of assurance, and they definitely have quality clients on their books. So that is the VNQ ETF, i.e. the ETF which tracks the real estate index of the United States of America. Now, another interesting ETF is the First Trust Dow Jones Internet Index Fund. Now, this ETF specifically tracks and focuses on companies that are operating on the internet. So companies which provide products and services on the internet. And to be specific, exactly what this trust tracks, it tracks literally the Dow Jones Internet Index Fund. That is what it tracks, the Dow Jones Internet Index. Okay. If we look here, inception date 2006. So it's been around 15 years. Expense ratio 0.52%, very expensive, not going to lie here. So they definitely are taking a chunk of your returns. So you would expect the portfolio, which does generate a very high return. Assets under management $10 billion. Isn't it amazing how we went from the VOO, which had over $150 billion, all the way down to a ETF which only has $10 billion. So just to give you an idea of the size, if we look here, guys, we see here that this portfolio likes to invest in high PE ratio companies, companies which are large, companies which have a track record of growing performance, companies which do not have the most sound balance sheets, so i.e. they have a little bit more debt than usual, and there's no chance that these companies are going to be paying out a dividend. and also it invests in companies which are slightly volatile. Okay, as we can see here, this portfolio has recovered very well following the pandemic, and also it is reaching new heights. Okay, and we can also see it tracks fairly closely to the benchmark. We can see here that the top 10, it is mainly based in the United States, and the main industry of focus is the internet and software and IT services, that whole industry. Okay, so that is the First Trust Dow Jones Internet Index Fund, and it's the companies you would expect operating on the internet: Amazon, Facebook, PayPal, Netflix. So speaks for itself. Then let's go on to the next one. Now, this fund has been catching some attention as of recent, mainly because of its founder, Cathie Wood. She's a well-known bull of Tesla, and her big bets on Tesla have paid off recently, and I think that's why this fund is getting a lot more attention than usual. So anyway, the Ark Innovation Etf. This ETF was born in order to invest into companies which are going to essentially provide a whole lot of value to the world in terms of providing innovative products and services which are going to just provide a lot of value to the world. That is the objective of this portfolio. If we look here, we can see here that it does have a high expense ratio, 0.75%. So when we are paying such a high expense ratio, we would expect the fund to provide significant outperformance when compared to the VOO ETF, for example. But we'll see if it does. Then if we look here, we can see assets under management, $6 billion. So also one of these smaller ETFs. If we look here, the chart the last year, we can see here that the increase has been quite substantial following the pandemic, so definitely a good recovery on their behalf. We can see here the last month, 3 months, year to date, 1 year, 3 years, 5 years performance, etc. It is definitely a fast growing fund. This now we can see here that they are mainly focused on investing in the United States of America, and we can see here also the industries which they are mainly focused in is the healthcare and technology industry. And like I said, Cathie Wood is very famous for being a bull on Tesla, and no surprise, it is their largest holding. Also, you have Square and Invitae Corp, which are in the software and technology space. So yeah, this is just a very popular ETF which has been mentioned a lot lately. So let's then move on to the Vanguard Consumer Staples ETF. Now, for you guys who don't know, there's actually research out there that shows that over, I think it was a 40 or 50 year period, the best ETF you could have invested in was a consumer staples ETF. So I just wanted to include this here. This is probably the most well-known consumer staples ETF, the Vanguard Consumer Staples ETF. Now, this ETF is obviously going to go ahead and track the performance of companies in the consumer staples sector in the United States of America. And as you can see here, founded in 2004, has an expense ratio of 0.1%, so definitely on the cheaper side, which is good for the shareholder. Assets under management, $5 billion, so definitely one of the smaller ETFs. If we take a look here, we can see here that this is pretty much a fund that is neither focused on high or low PE ratio companies, slap bang in the middle. We see here that it is focused on slightly larger companies because the low size factor is underweight. We see here that it is also focused on companies slightly, ever so slightly, which have a focus on, which have a good past performance track record of increasing their earnings. We see a focus on companies which have sound balance sheets, which pay dividends, and which are not that volatile, i.e. you don't have very erratic share price movements. Okay, now if we look here, the performance, we can see here from when the pandemic hit to now, it's not fully recovered, but it's pretty much there. Yeah, that's the performance so far, and we can see here that it has definitely been tracking very closely to the benchmark, so very well done on the fund manager's behalf. And then we see here that it's 100% invested in the United States.
the top sectors in your consumer staples, as you would expect: food and tobacco, and personal and household products, as well as beverages. And these holdings should all be company household names, which we should all be aware of. The household products, many of the popular household products: PepsiCo, Coca-Cola, Walmart. I shouldn't have to explain to you guys what these companies produce. They are all very well known in their respective field. Okay, so that is the VDC, the Consumer Staples ETF. Now, the last ETF, something interesting for all the inquiring minds of tomorrow, is the BOTS ETF, the Global X Robotics and Artificial Intelligence ETF. Now, I think it's quite obvious we are in the midst, or maybe since 2010 we were in the midst of the fourth industrial revolution, and that's what this ETF focuses on. Okay, it's very relevant, it's very hot, so to say. So the BOTS ETF is there to focus specifically on the fourth industrial revolution technologies and the companies that are driving this change. So, founded in 2016, very recent ETF, expense ratio 0.68%, okay, not on the cheap side once again, and assets under management under $2 billion, so very small. Okay, if we go down here, we can see the performance of the BOTS ETF. We can see it's already recovered from the pandemic and is reaching new heights. We can also see that the ETF relevant to its benchmark, it is also tracking fairly well. And yeah, obviously because this ETF was only founded 4 years ago, there's not even a record for the 5 and 10 year period, so quite interesting over there. Now, BOTS, we can see the countries. We see that this is not focused completely on the United States, and in actual fact it is well diversified. We have Japan, United States, Switzerland, United Kingdom, Canada. It's a very diversified portfolio, so quite interesting there. But when we go over here to the main holdings, there should be one company over here at least which everyone should hopefully recognize, which is Nvidia. They're very famous for their focus on GPUs, CPUs, chips, and all the many computer hardware, but also software. They're also definitely pushing into artificial intelligence stronger than many of the other companies I know. But yeah, there we go. These are the main holdings. These are all companies focused on artificial intelligence, software, computers, driving the fourth industrial revolution.
Okay guys, so those are 7 of the most popular ETFs in the world, and at least now you guys have a basis, a foundation that you guys can use in order to grow your knowledge of all the other ETFs out there in the world. So I do hope you guys all enjoyed this video. Please do drop down a comment below for any other videos you guys would like to see. And with that being said, that is it guys. Thank you so much for watching. I will see you all in the next video. Ciao ciao.